Can you explain why the Energy Secretary posted and then appeared to have deleted a post on X saying that the U.S. Navy escorted an oil tanker through the Strait of Hormuz?
Yes, I was made aware of this post. I haven't had a chance to talk to the Energy Secretary about it directly. However, I know the post was taken down pretty quickly, and I can confirm that the U.S. Navy has not escorted a tanker or a vessel at this time, though, of course, that's an option the president has said he will absolutely utilize if and when necessary at the appropriate time.
Something that was posted erroneously, could it be because of a staffer? What, I guess, will there be any consequences for this? I know you still have to consult, but just generally speaking.
Again, I would defer you to the Department of Energy to answer that question.
The White House trying to contain the fallout after the U.S. Energy Secretary deleted a social post claiming a military escort in the Strait of Hormuz that sent oil prices crashing. Investors are hunting for any signs of energy supply relief as the war in Iran continues with no end in sight. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Stocks rise and oil fluctuates after a report that the International Energy Agency is considering the largest crude reserve release in its history. Mitul Kotecha, Barclays head of FX and Asian EM macro strategy, will be joining us as the outlook for markets remains volatile. Asian economies are scrambling to save energy with restrictions ranging from fewer workdays and school closures to cutting down on travel. We hear more about the austerity measures Pakistan is putting in place from Mosharraf Zaidi from the Prime Minister's office, and with a potential fuel crunch building while AI strains global grids. We speak exclusively with the CEO of GE Vernova about whether power generation can keep pace. President Trump has warned Iran against laying mines in the Strait of Hormuz, threatening to blow up any ship attempting to do so. The U.S. military is escalating operations against Iran, with the Pentagon saying Washington and Israel are conducting intense attacks. Horizon's Middle East and Africa anchor Jumana Basachi joins us from Dubai. And Jumana, it does seem like the Trump administration very keen to get oil flowing back again through the Strait of Hormuz.
That's exactly it, Haslinda. Another night of an intensification of operations. And just in the last couple of hours, the Central Command, the U.S. Central Command, has said that they have now targeted 16 Iranian mine-laying vessels near the Strait of Hormuz. This is per a statement that they released. And earlier on, President Trump, a bit of mixed messaging coming through. Initially, he said he warned the Iranians to not lay mines throughout the Strait of Hormuz. He then said that there were no signs that they were doing so, obviously followed it up a few minutes later, suggesting that indeed the U.S. had started striking at any of those vessels with explosive devices. So it's clear here that the U.S. are taking it one step further and are looking to reopen the strait by force by eliminating Iran's capabilities to attack and to lay these explosive devices that could pose security risks to any vessels looking to transit through. Now, at the same time, earlier on, we heard from the Energy Secretary, Chris Wright. He also put up a post indicating that the U.S. Navy had successfully escorted one oil tanker across the strait. That post was up for 10 minutes. It was then subsequently deleted. You can imagine there was a lot of mass confusion around it. Later on, the White House press secretary saying that had not happened, but indeed the U.S. does reserve the right to do that at some point in the future. So a bit of mixed messaging coming through from the White House overnight. But at the end of it, what we do know is ultimately what the Defense Secretary Pete Hegseth was saying, and that Tuesday was one of their heaviest days of strikes in terms of joint U.S. and Israeli military operations. The Iranian sides continue to be defiant. They continue to fight back. Overnight, I will tell you, more sirens going off in Bahrain. Over here in the UAE, we all received incoming missile alerts in the middle of the night. They also managed to sustain a fire at one of the largest refineries again in the UAE, causing more disruption in the energy space. And then just a couple of hours ago, also Saudi Arabia reporting another attempted attack on their Sheba oil field. So once again, Haslinda, no signs of things letting up in this part of the world.
And that is just it. Almost 2 weeks into the war, Jumana, any signs of an off-ramp? What are the chances of that happening at all at this stage?
I think it's very difficult to see at this point, Haslinda, where exactly the off-ramp is going to come from, because the Iranian side continue to be very defiant. And we saw that with the appointment of the son of the prior supreme leader. That in itself was a very hardliner choice. If you listen to the language that's coming through, even Ali Larijani, a post that he put up on True Social yesterday, on X rather, threatening President Trump and essentially saying that he runs the risk of being quote unquote extinguished. So they're really fighting back here. Equally we heard from the Speaker of the House, the Parliament, also suggesting that not 1 liter of oil is going to be allowed to pass through the strait. Now, at the same time, they understand that this has become a major choke point for the global economy. You don't have to look too far. The CEO of the world's largest energy company yesterday, Amin Nasser, is saying that this is the largest disruption the region has ever seen. He likened it to a catastrophe that's unfolding in front of our eyes. So there is a lot of focus from the international community about alleviating some of the pressure on oil markets, which is why these news stories come out overnight saying that the IEA are working in conjunction with the G7 to release the strategic stockpile reserve. And it could be quite a substantial number per the Wall Street Journal reporting. Just to give you a bit of context here, back in 2022, after the Russia invasion of Ukraine, the SPR release was around 182 million barrels a day. They're saying that this time, 182 million barrels in total, I should say. This time, they're saying that the number would even surpass as what was released back in 2022, which gives you an idea of just how important this is going to be for global oil markets and for global leaders as well. Mark Carney, Canadian Prime Minister, is saying that G7 leaders are going to be hosting a virtual meeting today to discuss it.
Jumana Basachi, Horizon's Middle East and Africa anchor, we thank you so much for that. As we saw there, oil below $90 a barrel, allaying concerns in the market. Let's do a check on how oil is doing with Avril Hong. And of course, investors remain on edge despite oil prices below 90.
Yeah, I mean, you're seeing them struggling to price in these developments, whether it's the rhetoric on the signals that this could be a protracted war, or whether these ships through the strait are being escorted by U.S. naval ships. And, I think that is really still the sense that even though there is IEA potentially coming through with the release of the stockpiles, and to Jumana's point, this could be a historic amount, according to Wall Street Journal reporting. You do the back of the envelope calculation, and what we've been hearing from some of the analysts on Bloomberg TV is just not going to be enough to overcome what has already been disrupted in terms of production, refining since the war began, not to mention how the Strait of Hormuz has effectively been shut. So you are seeing, as traders perhaps struggle to price that, even though Brent is still sitting below $90 a barrel. Let's take a look as well at what's at play for FX, because after we got that IEA headline, the dollar did come under pressure, but note how it hasn't reversed the gains for this year, at least on the Bloomberg Dollar Index, or the gains since the war began, I should say. And it's getting these supports from where yields are. Don't forget we have a US CPI release as well, and also perhaps the return in some ways of the dollar as a haven currency. Has
Avril Hong, thank you. Well, joining me in the studio, Mitul Kotecha, Head of FX and EM Macro Strategy Asia at Barclays. Mitul, good to have you with us. I mean, we talk about stability somewhat, in terms of sentiment, but when you take a look at FX vol, that continues to be pretty elevated.
That's absolutely right. We'll actually vol across markets, right? If we're fair, we've seen equity equity vol elevated, rates vol quite elevated as well, and FX vol has followed suit. We have seen a bit of calming going into today's session, and I think the overall environment, clearly there's uncertainty, and we've just heard about the news on whether we're going to see, a quick end to the war, a longer end to the war. It still seems like there's no real resolution in sight in the near term. So it probably means volatility is going to remain elevated for some time. So even if FX vol has come off a bit, it's very difficult to see it ease to pre-war levels anytime soon. And I think we are going to be still in a very uncertain environment in that sense.
So dollar strength will remain for quite some time.
Well, I think it's interesting when you look at the dollar. Pre-war, everyone was talking about not necessarily sell America, some were, but it was certainly hedge America, right? And now it suddenly looks like the dollar's back as a safe haven, and dollars rallied on the back of this. We've estimated, for instance, a $10 rise in the oil price means around 0.5 to 1% rally in the US dollar. So it does look like it's, at least in the near term, a very favorable environment for the dollar. And even some of the traditional safe havens, look at the Japanese yen. It's not faring as well as you would have expected. So it does look like a cleaner trade at this point is to buy the dollar. At the same time, there's an economic argument. The US is still a net oil exporter. It doesn't get impacted as much. Of course, the consumer gets hit from gasoline prices, but from an economic perspective, Asia gets hit a lot more because of the amount of oil that Asia imports, what it means for Asian inflation, current accounts, etc. So, yeah, the dollar, I think, remains, at least in this environment, quite well supported.
But dollar currently supported by geopolitics. When you take a look at data out of the U.S., CPI, PCE, whatever data that you're seeing right now, does it support a stronger dollar?
The data...
Oh, what the Fed's going to do as well.
Yeah, look, absolutely. I think if we look at the data firstly, obviously we had a weak payrolls report at the end of last week. That has led to concerns about some slowing in terms of demand for labor, but we know the labor supply has weakened because of deportations, immigration controls, etc. But really, what has been driving US growth in the last year? It's been CapEx investment, AI investment spending, and that continues to be strong. Most of the big hyperscalers are talking about investment that's beyond expectations, and that's going to continue to drive US growth higher. Now, the composition of growth could differ. Obviously, consumer could be weaker than expected, and especially with higher oil prices, you may see a rebalancing of growth, but doesn't necessarily mean that overall growth is going to be softer in the US. And for the Fed, we still think there's a very good chance the Fed cuts in June and in December. Clearly, if there is an inflationary threat, and we get CPI coming out very shortly today, that's probably going to be benign because it's a pre-oil rally inflation. But if inflation starts picking up, that could complicate the picture for the Fed, as we've heard from a few Fed officials.
It's been bad news for emerging market currencies. What a massive outflow we've seen so far. What do you see central banks having to do, which central banks in particular?
I think for EM, clearly it is a hit, especially for Asia, which is a big oil importing region. I think what it means, for example, for this region is that central banks who were perhaps thinking of cutting rates previously may look to hold or even start to tighten. We still expect the likes of Bank Negara and MAS to tighten policy this year. But, we were talking about earlier about the Philippines. We had expected cuts before. Perhaps there's a change in perspective there and we've seen some of the central bank comments there. So I think it changes the perspective on easing. I don't think it necessarily means central banks are going to hike quickly in the region unless we see a more sustained and deeper rally in oil prices. There is a current account impact as well. Countries with weaker current account positions, such as India, for instance, will suffer from higher oil imports. And, when we look at the impact on FX, we find that currencies such as the rupee, Korean won in particular, Thai baht are quite vulnerable to higher oil.
Interesting to see that the Sing dollar was actually seen as a haven play before the Iran war. But now with the Iran war and the impact from, gas, which we are totally dependent on, the Sing dollar is seeing some weakness.
It is. And we've also identified Singapore dollar as a currency that's more vulnerable to an oil supply shock. That said, it is still quite benefiting from some of the safe haven qualities, and it's still in Asia, still one of the biggest safe haven currencies out there. So I think that's got to be, some of its weakness will be tempered by still some inflow safe haven demand for the Singapore dollar. And we're also seeing that in the way that the Singapore dollar is trading within the band. The Sing dollar near is still fairly rich in the band at present.
And of course, front and center is actually the yen and what the BOJ does from here. Would recent developments in Iran impact how it looks at its moves going forward?
Well, I think there's clearly going to be questions about whether the BOJ hikes in April, as we've been expecting and a lot of people expect. Potential could be for a delay, but we don't think so. We still think April is going to happen. The BOJ seems to be dismissing some of this move. Clearly, obviously, there's...
Rightly or wrongly?
We think rightly for now. I mean, again, we don't know how much oil prices are going to be sustained at these sort of levels. The BOJ anyway should be on a tightening path because, one, we've got a weaker yen anyway. Secondly, and as we saw from the Shunto wage increases, we're talking about wage growth close to 6%. And there's enough ingredients that the Bank of Japan has been focusing on to warrant hikes. So at least one in April, potentially later, but one in April still seems likely, and then followed up by a couple more hikes. We think the terminal rate could end up at 1.5% still in Japan. That could be longer. I mean, if we see a hike in April, it's not going to be quick, potentially even next year before we see the next hike from the Bank of Japan. But clearly there's enough in place for one hike. Now, the risk is, of course, if inflation is higher, there is going to be pressure, more downward pressure on the yen, then they may need to consider other hikes or more hikes in the pipeline.
And of course, Korean won, also one that has been hit pretty much badly. We had from the Bank of Korea saying that it is willing to support in whichever way it needs to. What do you see the BOK doing?
Well, our house view is that the BOK doesn't move on policy this year, all the way actually through into next year. Now, of course, yes, the Bank of Korea, as with other central banks, will be very much closely watching oil prices and how much that impacts inflation. But as yet, again, I think it's more a case where it adds some hawkish risks. Doesn't necessarily mean the Bank of Korea is going to tighten quickly. But again, the picture could change across the board if we see oil back at 120 or above and it doesn't come off quickly. And as we talked about earlier, Asia is vulnerable to higher oil, especially natural gas. The reserves of natural gas in the region are quite low. It's hard to store natural gas anyway, and that could start impacting inflation pressures fairly soon.
We keep hearing it's all about duration. If we see the Iran war somehow, we get an off-ramp in this war, do you see that reversal in the dollar that could happen really rapidly or not?
I think there's still going to be some uncertainties, as we've heard. We've seen the regime change. It's not necessarily one that was probably what the US would have wanted, right? So if uncertainties in the Middle East continue, if the Straits of Hormuz continues to be blocked, that's obviously going to continue to create tensions across energy markets. But, of course, for the dollar, if suddenly we start to see an off-ramp, things ease quickly, there's some reconciliation, and this all falls away very quickly, there is a good chance that we go back to that hedged dollar view again, that that US assets have lately have underperformed. The dollar has done well, but again could come back to that view that policy uncertainty in the US, potential risks ahead of the midterms, could put some risk back to the dollar. We're not there yet, though.
Best crosses for the next 12 months?
I mean, I think for us, again, near term, you want to be still long dollars. We like, for example, long dollar INR as one of the trades we have on. But we in Asia or Asia Pacific, Aussie dollar looks good. We think Aussie benefits from a super cycle, can be a little bit shielded from what's going on. So we do like Aussie. We've been having a short sterling Aussie trade. That's one of our favorite trades at the moment. 12 months time, if things do improve, we like carry trades again. One of our best trades last year was a long high carry versus low carry basket. That worked well until recently. So we're going to keep watching that.
All right, we'll watch that, Mitul. Thank you. Mitul Kotecha of Barclays. Still ahead on Inside, Chinese officials said to be frustrated by a lack of U.S. preparation for President Trump's visit later this month. We're live to Beijing for the details next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Chinese officials are expressing frustration over what they see as insufficient U.S. preparation for President Trump's upcoming visit at the end of the month. Our Chief North Asia correspondent Stephen Angle joins us now from Beijing. Steve, it does look like they have different styles of preparing for this meeting.
Absolutely. Very, very different styles. Xi Jinping and Donald Trump, and the way they run their administrations are extremely different. The Chinese like to have everything choreographed, planned well in advance. And there's a real reason why, one of the reasons why the National People's Congress, which wraps up tomorrow, it's a annual session of Parliament. They do it once a year because they have the whole rest of the year to plan for it, right? Same with state visits, especially one so high profile and so important to both countries that we're going to see in 3 weeks between Xi Jinping and Donald Trump. Whereas we've all seen in the first term and in the last year, the style of Donald Trump's administration 2.0 is very different than how the Chinese like to do it. In fact, we could probably assume that Donald Trump likes and thinks his spontaneity is an advantage. But that goes against what the host nation really wants. So we're hearing from sources that the Chinese side, floating this out there right now, 3 weeks before Donald Trump arrives, they're concerned that there has not been enough preparation and consultation between the two sides. Granted, the White House has been quite distracted, to put it quite mildly, with the war in Iran, with the upheaval of the tariff regime by the Supreme Court and other issues. Maybe China has not been the top priority. But look back in Haslinda 2017, in the first term of Donald Trump, when he came to China, he sent Rex Tillerson, his Secretary of State. He also sent his Commerce Secretary to China in the months before that to sort of lay the groundwork. That has not happened this time. There's been a low-level team that's been here for a little while, but we haven't seen those high-profile visits and dialogue to set the agenda, set the choreography, and set the deliverables. So it's a wild card for Xi Jinping in just 3 weeks.
Trump may be distracted, but he says he remains committed to making the Strip. You got to wonder how much of Chinese interests are at stake here at this particular meeting.
Well, absolutely, they are. And they've doubled down on saying how important this summit is going to be. They didn't cancel after the Trump administration, along with the Israelis, bombed Tehran, which I thought they might do because of the close ties between Tehran and Beijing. But no, in fact, we've heard the opposite. They are looking forward to this. They want to have a more fundamental relationship with the United States. They got some of the trade issues resolved, at least in a year-long truce late last year. So this was an opportunity for the Chinese perhaps to talk about much deeper strategic, even defense-related issues, in particular Taiwan. We're hearing that Xi Jinping wants to hear directly from Donald Trump on his Taiwan policy, because keep in mind, there is a military hardware package ready to be approved and signed by Donald Trump, but it's on hold right now, perhaps until after this summit, or maybe Xi Jinping can convince him to not do that arms sales package to Taiwan. So again, a lot is in the balance right now, but these are things that would normally have been discussed perhaps in the run-up to that. We are having a meeting this weekend, another trade round, if you will, between the USTR, Trade Representative Jameson Greer, Scott Bessent, the Treasury Secretary, and He Lifeng of the Chinese in Paris, but it doesn't really set the groundwork for deeper defense and key issues that go beyond the trade relationship.
Steve, thank you so much for that. Bloomberg Chief North Asia correspondent Stephen Angle in what is a beautiful day in Beijing. Still to come, Pakistan curbs government spending to save fuel as the Middle East war chokes supplies. The Prime Minister's spokesperson, Mosharraf Zaidi, will be joining us next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Governments across Asia are taking measures to ease a fuel crunch triggered by the conflict in the Middle East. Energy and Commodities Managing Director Clara Ferreira-Marquez joins us for more. Clara, good to have you with us. I mean, Asia is in a lot of pain. There is a lot of oil crunch right now.
I think you're quite right. So what we're seeing across Asia, in some cases because of a supply crunch, in some cases because of the price spike that we've seen across fuels, is a lot of pain. So we're seeing a lot of governments coming in with austerity measures of various kinds, 4-day weeks, school suspensions, all kinds of measures to really try and shield consumers as much as possible. The longer this goes, of course, I'm sure you've heard this on the program many times before, the more painful it will be.
And of course, fuel shortages in the likes of Sri Lanka, in Pakistan, how bad might that be when compared to other incidents?
I mean, ultimately, these things are prompt. So they are right now. They are largely because of where the fuel crunch is hitting. So if you look at India, Pakistan, most of South Asia, it is in liquefied petroleum gas. So that's basically cooking gas. The alternative supplies, so supplies that don't come from the Middle East, have to come from the US. Even if they come from the US, they are not specifically geared for cooking gas. So it's going to be very difficult to fill that gap, and it's not something you can do immediately. When you look at the wealthier governments around Asia, they are able to go into the market and bid for supplies. And they also don't use gas in exactly the same way. So South Asia is definitely where we're seeing probably the toughest moment, but Southeast Asia too has imposed quite a lot of austerity measures pretty much across the region.
Are there alternative sources? I mean, when you take a look at South Asian economies, they've had this issue for decades now. Is there a way to ensure that their energy security is more intact than what it is now?
It will depend on the fuel that you're talking about. So if you look at gasoline, diesel, yes, there are things that have come up in the region. If you look at refining capacity, yes, it is better than it was. But fuels aren't stockpiled the way that crude is, for example. And for LPG, these are specific fuels that are really imported, directly made. So they're not importing crude and then making it here.
Clara, thank you so much for that. Bloomberg's Clara Ferreira-Marquez there. Let's get more on Pakistan's fuel-saving steps. Joining us now is Mosharraf Zaidi, the foreign media spokesperson for the Pakistani Prime Minister. Good to have you with us, Mosharraf. First of all, give us a sense of how bad the situation is in Pakistan. What's being done to alleviate the situation?
Thanks so much for having me on, Haslinda. Look, thank God the situation in terms of our supply chains, our current stocks, and our active contracts where we know shipments are on their way, I think things are, I would say, stable to good. Of course, the increase in petroleum prices and diesel prices a few days ago has hit the Pakistani consumer really hard. And so there's obviously a lot of concern. The Prime Minister in particular has spent his entire term, as you know, Haslinda, working with the IMF and taking really, really difficult decisions in terms of taxation rates, in terms of fuel prices, in terms of electricity subsidies, and making sure that while we move the economy slowly but surely towards a more balanced, a more sustainable set of metrics in terms of how we price things, we're also shielding the ordinary consumer and the ordinary Pakistani, and especially the taxpayer, both individuals and businesses, from the worst part of it. Now, that balance has been more towards the system reform and the changes that were required, and that means that the Pakistani people have taken on a lot in terms of the pain that they've experienced. Right. This latest crisis is yet another example of that. But as a result of that, there's been a series of measures that we've taken to mitigate some of that.
So no risk of a energy shortage at this point in time. And what oil price would you be worried and more steps would be taken?
Haslinda, as you know, we watch Bloomberg really carefully to listen in on, people citing numbers. So it would not be fair for me to cite any number, in terms of stirring any kind of panic. Just over the last 24 hours, we've seen prices, 36 hours, from 120 back down to about 80 to about 90, where the markets might have closed last night. So I think, the real task for us here in Pakistan is to make sure that no matter what the price is, that on the gas, at the gas station, on the street, in ordinary day-to-day life, the Pakistani consumer doesn't have to face any kind of cataclysmic or dangerous sort of shortage of fuel or shortage of supply. So I think it's about
But what other steps might you take? What other steps might you take if this crisis gets prolonged?
Well, I think what we've done is we've mitigated against the risk of a prolonged crisis by taking really difficult decisions right at the top. So I think Pakistan might have been one of the first countries in the world to increase fuel prices in anticipation of what was about to happen. And we've taken the Prime Minister and the Field Marshal and national leadership has taken a lot of flack for that. But I think what we've seen just in the past 4 or 5 days is that that's cushioned Pakistan, both in terms of our supply chain certainty, because our oil marketing companies and the people that are responsible for maintaining stocks have the cushion that they need to make sure that the different supply chains they have to pursue. Usually, fuel takes about 5-6 days to get to Pakistan, given how close we are to the region. But because of the Strait of Hormuz, those supply chains are closed. So the alternative supply chains are as many as 18, 19, and 20 days. That really creates a gap. Part of the measures that we've taken in terms of conservation and austerity include a 4-day work week, a lot of work from home, a substantial reduction in government usage of cars. And then there's some more exciting things, bigger challenges, probably more medium and long term. But I think the move towards electric vehicles has been ongoing and throughout Asia. And I think certainly in Pakistan, we're looking to ways to speed that up. I think this, as every crisis is, it's an opportunity for change. And I think the Prime Minister and his entire team are looking at making those changes to prepare the Pakistani people for, I think, a substantial set of changes to how the world works as we look at what's happening in the Middle East.
Mosharraf, as we talk about the Iran war, attention is also focused on the defense agreement that Pakistan signed with Saudi Arabia. Tell us more about that. Is there a sense that Pakistan might come to the aid of Saudi Arabia militarily or otherwise?
I mean, one thing to really be very clear about right at the top, the question isn't whether Pakistan might come to Saudi Arabia's aid. I think both countries even before the Strategic Mutual Defense Agreement, have always operated on a principle of being there for the other before they need the other. So I think there's no question that we will, no matter what, and no matter when. So I think, that there's no question about that. The real question is, what is Pakistan doing to make sure that things don't come to a point where any of its closest partners are further embroiled, further sucked into a conflict that potentially undermines stability and prosperity, not just for the region at large, but especially for the Pakistani people. You would already know that, for example, our Field Marshal visited Saudi Arabia a few days ago. We're constantly in touch with the Iranian leadership. Our Prime Minister and the Field Marshal have a great relationship with the U.S. leadership. I think over the past 6 or 7 days, there's been a whole series of conversations. And I have to say, one of the things that I think Pakistanis really admire is the way in which Saudi Arabia and the other Gulf states have actually resisted being drawn in. We've seen all kinds of appeals from some people in the United States and other places wanting the Saudis and the other countries in the GCC
Mosharraf,
to get more actively involved, but they've resisted, and I think that in part that's part of what Pakistan wants to see is greater.
How close is Pakistan? How close is Pakistan in providing that military aid to Saudi Arabia? What would it take?
Well, we don't look. I think that would be speculative and irresponsible for anyone in any position, certainly as low-ranking a position as mine, to make that kind of speculation. But as I said to you right at the top, there is no question that if and when whatever is needed from Pakistan vis-a-vis Saudi Arabia, Pakistan will be there before it's needed. And similarly for Saudi Arabia, you may already know, for example, that Saudi Arabia has already made arrangements to support Pakistan's supply chain stability in terms of oil and diesel and crude. So I think both countries are really tied to each other, both formally and informally, and there's no question of whether there would be any kind of if. There's whenever Saudi Arabia needs, Pakistan is going to be there.
Is Pakistan in touch with Iran? Are there messages being sent to Iran on, suggesting de-escalation?
Haslinda, I think this is a really good opportunity for me to talk a little bit about this. You know, the Pakistani Prime Minister, my boss, has been meeting with the Iranian leadership constantly since he took office in his second time as Prime Minister in March of 2024. There have been 6 one-on-one meetings between the Prime Minister and the President of Iran. There's been multiple visits bilaterally. They've met in other places in New York and other multilateral fora. Over the last week and a half, 2 weeks, there have been constant conversations between the Deputy Prime Minister of Pakistan, who's also our Foreign Minister, and the Foreign Minister of Iran. Those conversations, as well as other conversations, are the reason, for example, that you've seen some of the conciliatory efforts that Iran has made towards the Gulf countries. So I think we're very conscious of the responsibility that Pakistan has as a close ally and friend to these countries, all of them. We're also very conscious of the negative impact of this conflict, not just on Pakistan, but on the whole region. And so in keeping with our role, I think we are constantly talking not just to Saudi Arabia or Iran, but indeed to all the other countries in the region.
But what is your core position on this war in Iran? You've condemned the attacks on Iran. You've also condemned the attacks that Iran has made to the Gulf nations.
Well, that clearly, I think you just stated our core position. Our core position is we don't like our friends getting into quarrels with each other. We certainly don't like innocent people dying needlessly. We think that there is always a pathway to any kind of conflict that is achievable through dialogue, and we don't believe that there's ever a time, especially in this context, where Iran should be attacking the Gulf countries and where the people of Iran should be withstanding or having to endure the kind of, I think, really cruel bombing campaign that they're enduring currently.
Right. Mosharraf, there's also been suggestions that Pakistan could provide escorts through the Straits of Hormuz. Give us a sense of how that might work and how realistic is that?
Well, I think first and foremost, Pakistan is responsible for its own territory, and that includes our sort of maritime and naval domain. You will already know that the Pakistan Navy has been providing escorts to shipping lanes that are in Pakistani waters. If there was to be any kind of expansion of that role beyond our territory, that would be in a multilateral forum, and I haven't heard any such discussion so far, including, I think what's really interesting is what happened yesterday, where there was a claim that the U.S. was escorting ships through the Strait of Hormuz. And then, of course, we heard that that was rescinded. So I think the Strait of Hormuz is a really tricky one, and we're certainly nowhere near making any sort of support missions for such escorts at this time. What we are doing is making sure that Pakistani waters are safe, and that those operations have been ongoing for 3 days now, and the Pakistani Navy, the brave sailors and soldiers of the Pakistan Navy, have been enacting those with great courage and professionalism.
Mosharraf, of course, Pakistan itself is in conflict with Afghanistan, and that conflict is escalating. How prepared are you for an escalation, further escalation of what we're seeing right now?
I'm not sure that I would frame that as a conflict with Afghanistan. I think we are in a conflict with the Afghan Taliban regime that has been hosting and giving safe haven and support to the Taliban terrorists that have been attacking Pakistani school children, Pakistani mosque goers, Pakistani housewives and mothers and children, and soldiers and policemen. There are also other terrorist groups, in fact, a whole alphabet soup of terrorist groups in Afghanistan that enjoy the patronage of the Afghan Taliban regime. And after having a process of dialogue and conversation with that regime over the past 3.5, 4 years, it was only when Pakistan was attacked by the Afghan Taliban regime that we sought to defend our territory and our people. We'll continue to conduct counterterrorism operations until there is a clear break between the Afghan Taliban regime and the terrorist groups that are provided succor and safe harbor in the territory that they currently control. But of course, Pakistan and Afghanistan are neighbors, and there's never any question of conflict with Afghanistan at large.
Mosharraf, thank you so much for your time today. Mosharraf Zaidi, Pakistani Prime Minister's spokesperson for foreign media. Now, still to come on Inside, India approves a major policy shift, relaxing foreign direct investment rules for bordering countries, primarily China. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's been trading for about 3 minutes now. Let's do a check on where Indian markets are at this point in time. We're seeing some stabilization. The Sensex up about 1/10 of 1%. Of course, the Indian stocks came close to a technical correction just earlier this week after oil prices headed towards $120 a barrel. But with oil prices now below 90, there's some consolation, some comfort among Indian investors. The Nifty index currently up about 1/10 of 1%. Let's do a check on a stock we're focusing on, IndiGo in particular. CEO Peter Elbers has resigned with immediate effect, citing personal reasons. The sudden resignation comes at a pretty tricky time for the company, which is struggling with the disruption caused by the Iran war, as well as rising jet fuel prices. It had faced regulatory scrutiny and fines after mass cancellations back in December. We'll have more on this later on Inside. Meantime, the stock is up about 1.5%. Investors are paying the most since July 2024 to protect against turbulence in Indian shares. Implied volatility has soared this month as the benchmark index joined a global sell-off sparked by the Iran war. Let's bring in India equities options reporter Savio Shetty. And Savio, why is implied vol in India spiking so sharply now?
Hello, Haslinda. Nice talking to you. It's very clear that we had actually done a piece last year which essentially suggested that India was one of the calmest markets in the world when it came to implied volatility. But you have a couple of factors here. You now have heightened geopolitical risk. You also have the energy crisis that has come to the shore. And compared with that, with a complete lack of an artificial intelligence trade, it's clear that traders in India are a bit worried about the markets, and implied volatilities have spiked to high levels. They did come back below 20 yesterday and probably trading at around 17, 18 right now. But overall, traders are a bit skittish on what's happening locally as well as globally. And a combination of both of these things are getting them to buy more and more put insurance.
In terms of the India VIX, it is much higher than realized volatility. What does it really tell us?
Yes. So essentially, the actual moves that have happened in the past have been much lower than what the market implied for it before it. But there's a sense that this gap will actually shrink further because we have a combination of domestic as well as international factors, which will probably keep pushing the VIX higher. We have to remember this in the context that India was one of the absolute calmest markets last year. You had single-digit volatility, something that is so rare to find. And on the back of that, we come from an extremely low base. We have the VIX now somewhere in the high teens, and traders seem to be buying more and more put protection to take care of it.
And Savio, for years, domestic liquidity has cushioned foreign selling. Is that buffer now weakening, you think?
I wouldn't call it weakening. Yes, it has trickled down a bit, but overall, domestic investors in India have been completely on a buying spree for probably the last 3 to 4 years. Indians are buying the country, and it is very clear that whenever there is a dip, you have some kind of mutual fund buying coming in. I think a lot of people expected this to happen this time, and we are actually seeing it. There's also the technical factor of the 100 weekly moving average, which has been broken the last time only in 2020. So it's clear that there are these technical reasons and fundamental reasons in terms of locals buying the stocks up.
Savio, thank you so much for that. Bloomberg India Equities Options reporter Savio Shetty there. Now, India has approved a major policy shift, relaxing foreign direct investment rules for bordering countries, primarily China. It's a bid to boost domestic manufacturing in key sectors, including electronics, capital goods, and solar cells. Bloomberg's Shruti Srivastava joins us from New Delhi with more. And Shruti, what are the implications of these changes?
Thanks, Haslinda. So first, let's see what the changes have been made. There are two critical changes which have been made in the so-called Press Note 3, which the government had, notified in 2020. For the last 6 years, the investments which were coming from the land bordering nation, especially China, were being scrutinized heavily by the Indian government. But now what the government has done is the government says that in certain select sectors like electronic capital goods, silicon and ingot wafers, polysilicon, electronic components, all these sectors will see expedited clearance of their FDI proposals which come in the country. The government says that proposals in these sectors would be cleared in 2 months' time. The other thing that the government has done is it has said that the entities which have a non-controlling stake of 10%, they can get automatic approval from the Indian government subject to certain conditions. Now, this is a big change from the Indian perspective. This signals that the government is now trying to attract more capital in the country. It's trying to do value addition. It's trying to bring in new technologies in the country, especially in these sectors. This is a huge shift from India's policy earlier, and it shows that the government is trying to attract more capital at a time when the war in the Middle East and rising oil prices raise fresh uncertainties for India. So implication-wise, we have seen Chinese companies expanding their footprints in the country, and it's likely to give them a big boost.
So what does it all mean for the India-China relationship?
This latest move by the government clearly shows that the Indian government is trying to deepen its economic ties with its Asian rival. The relationship between the two countries had deteriorated in 2020, which culminated into a Himalayan clash in the same year. Since then, last year we saw some thaw emerging, and both the countries moving to reset their diplomatic ties after Trump's high tariffs impacted the global supply chain, and we have seen that the two countries have resumed flights between the nations. We have seen the regulators, starting clearing some of the investment proposals. This is yet another step in that same direction, where both the countries are trying to get a diplomatic reset, though limited.
Shruti, thank you so much for that. Bloomberg reporter Shruti Srivastava in New Delhi. And we have breaking news out of China. China moving to curb OpenClaw AI use for banks as well as state agencies. The Chinese authorities, in fact, saying that government agencies and state-owned enterprises have received notices warning them against installing OpenClaw software on office devices, with some employees banned from installing it on personal phones as well as using the company's network. And the warning underscores Beijing's growing concern about OpenClaw, which requires broad access to private data and can communicate externally, potentially exposing computers to external attack. Now, more to come in our next hour of Insight. Welcome back. You're watching Insight. As we reported earlier, Chinese authorities moved to restrict state-run enterprises and government agencies from running OpenClaw AI apps on office computers due to potential security risks. For more, let's bring in Bloomberg's Annabelle Drulis. And Belle, first of all, explain to us what OpenClaw is.
Yeah, this is obviously needs some attention because it's a technology that's really just come out of nowhere and has captivated a lot of attention globally, but most notably in China as well. So the idea of this is that it's an AI assistant that doesn't just chat, it actually does stuff for you. So most AI tools, you go to them. So you go, for instance, to ChatGPT, you go and access Gemini, you go and access DeepSeek. But in this instance, it's actually the technology that comes to you instead. So the idea of it is that it runs 24/7 on a server, it connects to apps, it can take actions without you asking. But the three main ideas here is that essentially there's the brain and memory component, where OpenAI or OpenClaw rather is connecting to AI models via API, so it can remember everything about you. It can get better with its knowledge of how you operate over time. As I said, it runs 24/7, and also the tools and actions, so it can connect to things like Telegram, Gmail, Slack, Discord, your WeChat, your WhatsApp, and then again actually do things on your behalf. So that's sort of the technology and why it's relevant today.
So in terms of China's actions, the actions that China's taken right now, that's on the back of this OpenClaw mania in the country, isn't it?
Yeah, so we can get to the mania first maybe, and then we'll talk about what's been the response. But certainly it is a technology that's captured just so much attention in mainland China. And it's really also been something that's led by big tech. So you've seen, for instance, the likes of Tencent that's been encouraging people to actually download and use OpenClaw technology. You've seen the likes of Minimax, for instance, sharing or releasing AI agent tools that are compatible with OpenClaw. So it's all trying to, I guess, capitalize in a sense on this hype, and that's why you've seen really big run-ups in certain stocks. Of course, we have had a reaction to this. I mean, Minimax was already under pressure in the session today, but Tencent has certainly been paring some of its gains. We're into the lunch break now for mainland China as well, so we won't see any specific market reaction just yet, but that has been sort of where you've seen it really being led by big tech especially, but also across lots of different social media as well. People really captivated again by this technology.
Belle, considering what OpenClaw can do, I do wonder if countries beyond China might take a similar action.
Well, we can get into the action then of how China has essentially responded to this, because it's a scoop that's just dropped in the last few minutes. So essentially what Chinese authorities have done now is they've moved, or what we've heard from our sources, that they've moved to restrict state-run enterprises and government agencies from running OpenClaw AI apps on office computers. So they're essentially trying to diffuse any sort of security risks that come from this. So what we've heard again is that these different agencies have received notices in recent days warning against installing OpenAI or OpenClaw software rather on office devices, and that is due to security reasons. I mean, it's not really surprising. OpenClaw does actually use or have the capacity to access a lot of different private data if you are using it to its fullest extent. So yes, to your point, could we see this being applied elsewhere? It's certainly possible, given that it's hard to see governments really that want to get sensitive data that's put into the hands of private enterprise, essentially.
Belle, thank you so much for that scoop. That we have on Bloomberg. Something to tell you about, of course, Cathay Pacific earnings, one we've been watching. Its financial year net income coming in at 10.83 billion Hong Kong dollars. The estimate was for 9.07 billion. It is a beat. It says that supply chain disruptions impacting delivery of new airlines, and that the growth in passenger capacity is at about 10% in 2026. It expects that growth to be around 10% in the coming year, in the following year, and that it will take delivery of 8 new narrow-body aircraft. That's according to Cathay Pacific. Again, in terms of its earnings, it is a beat, 10.83 billion Hong Kong dollars versus an estimate of 9.07 billion. Meantime, staying with the airline space, IndiGo's CEO Peter Elbers has resigned with immediate effect, citing personal reasons for his decision to step down. Our aviation reporter Meher Mishra joins us from Delhi. Meher, give us the context of this development.
Okay, so the issues, this definitely is linked to the issue of massive flight cancellations that IndiGo passengers had to face during December, wherein about 3,000 flights were cancelled within a period of 2 to 3 days. It all started there. That was the first disruption that IndiGo had seen since its inception in 2006. So that was big for the airline. It not just impacted operations at the airline and financials at the airline, but it also impacted its public image, which till then was considered as some airline which will be able to operate is very efficient when it comes to operating an airline. So clearly that was something that has impacted that showed that the management was not clearly the management then, which was Peter Elbers was the CEO, was not somehow missed the readings of the situation that went out of control. Now it all started there. Now we can always look at the resignation letter that the airline released yesterday. It says personal reasons by CEO Peter Elbers, but the fact that the airline let Peter Elbers go without serving any notice period, so clearly the airline did not even the airline board did not even want Peter Elbers to handhold during the transition period, clearly shows that December flight cancellations did have an impact on IndiGo CEO's resignation.
Meher, have operations at the airline stabilized since the meltdown in December?
So since the meltdown in December, the Indian regulator has curtailed IndiGo's flight by about 10%, domestic flights. So they are operating with on a curtailed schedule. Now that schedule has not been restored. However, they had some exemption in terms of FDDL relaxations for pilots, etc. That has been waived off. They are operating. So in terms of being able to manage their pilots, they have kind of stabilized. But in terms of number of flights that they operate in the domestic space, that continues to be curtailed, and it will be curtailed till the end of summer schedule, which ends this month, end of this month. And there are expectations that there will be some relaxations in terms of curtailment of flights going ahead as the summer schedule begins March end this year. Now, there is also this fact that while IndiGo was trying to kind of come back to normalcy, working on various aspects of airline operations, there is also issue that we are seeing in terms of Gulf disruption that is impacting operations across the globe.
And here, in terms of the impact from the Iran war, what are we seeing, the impact on IndiGo as well as the industry as a whole?
Okay, so the impact is huge. When you look at IndiGo's operation and operations of all Indian airlines, they are heavily. There is a lot of Indian diaspora in the Middle East, so there is a large number of flight that goes into and comes from Middle East. So that was a big market for Indian airlines. The Indian airlines are facing a major problem because of the Pakistani airspace closure. What that has led to is they have to take They earlier had to take longer route, which was to fly over Iran to enter Europe airspace and then to Europe and US. That because of this Middle East problem, that route has been impacted. So they are taking a longer route over Africa, which means longer flight hours, more cost for the airlines. So that definitely is impacting their operations. So the impact is multiple. One is on account of demand that was coming in and out of the Middle East, and the second is out of longer routes. In terms of IndiGo, they had substantial operations into the Middle East, which is impacted. But at the same time, they were also expanding to long-haul markets through these newer aircraft that they had acquired and are on lease. That has also been impacted.
Meher, thank you. Bloomberg India aviation and infrastructure reporter Meher Mishra. So as airlines across the world grapple with rising fuel prices, let's get more on the outlook for energy markets with our panel of guests. Jun Go is Senior Oil Market Analyst at Sparta Commodities. Also with us is Lin Ye, Vice President of Commodity Markets at Rystad Energy. Jun, let's start with you. What do you make of the reaction in the oil market so far? It's been pretty turbulent. We're seeing massive moves.
We started this thing about 10, now it's the 12th day now. And I think the market reaction has been very muted given the scale of disruption that we are talking about. Here we have about 20 billion barrels per day of oil that is literally stuck at the Straits of Hormuz. It can't come out, it can't go in. And today the market has priced down to $90 per barrel or so, versus the height of $119 on Monday when we came in. So in my view, the markets are really too relaxed given the situation that we are in.
Lynn, is the market too relaxed? We've seen volatility in oil prices and moves of more than $30 a barrel. What do you make of it?
Yeah, it is a crazy day, Monday, right? Just over the weekend, a lot of things happened, and even more shut-ins happened among the Gulf producers. So I think that was the kind of reason behind a surging of oil price on Monday, and then suddenly it plunged a lot on the news of IEA release, and also on Trump's end of war speech. And I think, it works, because I think the current urgency for Trump is to bring the prices down, right? Because it matters to his later election in the US. So I think everybody is still discussing whether the proposal of the IEA release will be approved or not. But let's see. I think it has already worked on the market. And compared with gas, I think oil is a bit calmed or relaxed. I agreed with Sparta Analyst. So yes, I think probably the market thinks the strait won't be closed for very long. And we see the signal of ending of the war, probably will happen very soon. And I think the market agrees that probably we can see the strait reopen by end of this month. And also it's the assumption for our base case right now.
Lynn, it's been pretty confusing when it comes to the messaging from the IEA. Just days ago, we heard the IEA say there's no reason to release the strategic reserves, and now, days later, it's looking at, releasing the most in its history. Try to make sense of that for us.
Yeah, I think it's because, the biggest release in the history, last time it was during the Russia-Ukraine war, which impacts apparently the Europe the most. And a lot of the members within IEA, of course, lies within the Europe and the Americas. So that means in this time, the disruption of the Strait of Hormuz basically impacts Asia the most. So I think it is driven by the different demand and different natures of these two conflicts. And this time, of course, the Europe, they are not facing immediate energy crisis like Asia. So probably they think there is no urgent need to release. But in terms of control the price, I think they will be on board later, to really help the Asia to survive this.
June, what's your take on whether or not those strategic reserves are actually quite political? There's lots of politics involved in that. What are you seeing?
Well, if you're talking about that, potentially 300 million barrels per day of oil being released into the market, coming down headlines, coming down the oil markets, the reality is it boils down to the drawdown rate of those barrels. So I just talked about 20 million barrels per day of shortfall into the market. Can we see 20 million barrels per day equivalent flowing out from that 300 million barrels per day? Based on our calculations, no. It's more likely, well, it's your guess, it's anyone's guess right now, but maybe between 4 to 10 million barrels per day. We are still looking at a huge shortfall if the Straits of Hormuz remains disrupted. What might that do to prices? You mean in terms of the
impact on prices?
Okay, so if indeed the IEA releases those barrels, we will see oil price, the futures market coming off. But the physical market remains very, very strong. You do have a shortfall of oil, whether in crude, feedstocks, transportation fuel, everywhere. And the physical premium will need to increase if the futures market is not playing ball here.
And June, when it comes to the production out of the Middle East, how much of that production can actually get to the final destination?
We have now seen a shortfall of, from production shut in close to 6 to 7 million barrels per day. So even if the Straits of Hormuz reopens, we are going to see lower flows. And Asia is the biggest consumer by far. 80% of those flow come to us in Asia. So we will continue to see a shortfall of oil that we sorely need right now to run on base load and also to re-inventorize whatever that has been lost.
And Lynn, your take on what developments are expected from here in the oil market?
Yeah, kind of agreed with June. Like the current shut-ins are between probably 6 to 7 million barrels per day, and it's going to rise. I mean, the number could rise very quickly because according to our assessment, we think the storage capacities in these Gulf producers are very limited, and they will face very immediate urgency to really close the production of the oil fields within probably another 1 or 2 weeks. So there is a countdown for them, and also it will take time for them to recover the production, even if the strait will be opened again. Agreed. And also we need to look at this issue from two different aspects, crude oil and products. So we talked about the IEA release will of course, help with the crude oil supply and demand very soon, very quickly. But then refineries need to process this crude oil into products to support the product demand. So when talking about products, actually out of the 20 million barrels per day through the Strait of Hormuz, I think more than 5 million barrels per day are the oil products, including naphtha, LPG, and fuel oil, and even jet fuel and diesel to Europe. So these oil product barrels are really causing a feedstock crisis for Asian petrochemical plants right now. So we are seeing a lot of force majeures from the producers in Asia. So that is something that, I think the IEA release will not tackle.
Right. Which refiners in Asia are most at risk?
Actually,
yeah, sure.
Okay, so many of the refiners here take Middle East crude as their base load. So I would say almost no one is spared, except those that have domestic production, like in Malaysia and to some extent Indonesia. But really, the 84% of that crude coming from Middle East ends up in Asia refineries. So Japan, Korea will be big. Will have a huge hit. Singapore, of course, yes.
Right, and of course, when we talk about production, it is not just in the Middle East. There are producers outside the region, including the U.S. Can they counter what's been lost in terms of Middle Eastern production?
That is a good question. We talked a lot about the flexibility of U.S. shale. We think they can act very quickly, but according to our analysis, actually they are run out of the so-called DUCs, and the current DUCs can only help the U.S. to maintain the current production level, and it will take 4 to 6 months for them to really increase the current production. So it will not help with the immediate supply shortage. And also on the Strait of Hormuz, the Asian refineries are, announced a lot of export ban at current time. I think it's very reasonable, and that it means the countries that are relying on imports of fuels will face immediate shortage. So for countries like Australia, the Philippines, and even Vietnam, they rely on a lot of the gasoline and diesel imports from other countries, so they will face very immediate shortfall. And also in terms of crude, actually we look at this issue from two perspectives. One is how long their current inventories could cover their import demand, and also do they have alternatives to support. So India can access more from Russia at this moment, which will help them a lot. And then Japan and China will be in good positions with vast crude oil inventories. So, different countries will face different situations at this moment.
And your take, June?
My view is a quality issue. Even if the U.S. saves the day and produces that much more shale oil or light tight oil, the quality is too light for our Asian refiners. We are used to medium sour crude. We are designed for medium sour crude. So there will be an incremental pool of those barrels from the US, but they cannot manage, they will not be able to resolve the entire shortfall that we are seeing right now for the 6 to 7 million barrels per day lost from the Middle East.
Interesting view there. June Goh of Sparta Commodities and Lin Ye of Rystad Energy. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Global ship management and marine services company V Group says a secure solution for navigating the Strait of Hormuz is urgently needed. Speaking exclusively to Bloomberg, the company's CEO told us the strait is now effectively blocked.
Right now, as a snapshot, it's closed. I mean, you have a trickle effect of ships going through, but not in any material way. So definitely you should consider it as a dislocated bottleneck.
It's a precedent, and to be fair, it's not just President Trump. It was Macron yesterday, too, talking about, do we get naval escorts? Trump saying that he wants to reopen the Strait of Hormuz. What would it actually take to allow the confidence to have ships be able to go through, and I guess to get the insurance to allow them to do so as well?
So if you take a step back, I think shipping is not adverse to these dislocations. We have had it in many, many ways throughout decades or even centuries. 90% of global trade is actually seaborne. It's the most efficient way of traveling goods and services on the water. But when you find bottlenecks like this, it's not that we're not resilient, it's not that we don't find solutions. The first point is the seafarers, because we don't have autonomous ships. So we need to ensure that we have a safe passage, however that is, regardless of the dislocation. So that's alpha omega. Secondarily, obviously, we need to ensure that then the assets can come all the way into their destination. And do remember, as I mentioned before, it's a cul-de-sac. And all the residents in that cul-de-sac obviously benefits from being able to have the trade flow. So there has to be found a solution for safe passage. There has to be found a solution for security going through. The strait is narrow. You have 2 lanes in and 2 lanes out. So we are waiting for a solution. In the meantime, we are ensuring that all seafarers, all ships are being looked after, waiting for what can be done. But there is not a direct replacement.
Coming up, with a potential fuel crunch building.
We are in this very curious and unfortunate situation, I would say, that the prices that we are seeing on crude futures are simply completely disconnected from ground realities.
I think the difficulty is that the markets were perhaps too benign over the whole inflation story. And I think what we're going to do now is actually experience that inflation shock much, much quicker.
IEA may provide some relief, very small temporary relief, I would say. At the end of the day, the Strait of Hormuz needs to reopen, or at least in the physical market, physical oil prices will remain and continue going up in triple-digit territory. Just forget about what you're seeing on your screens with regard to the futures.
Some of our guests reacting to the oil supply shock driven by the Iran war. As the fears of an energy crisis rise, the European Commission president described Europe's move away from nuclear in recent decades as a mistake. Speaking at a summit in Paris, Ursula von der Leyen also announced a €200 million guarantee to support private investment in nuclear technology.
While in 1990, 1/3 of Europe's electricity came from nuclear, today, it's only close to 15%. This reduction in the share of nuclear was a choice. And in hindsight, it was a strategic mistake for Europe to turn its back on a reliable, affordable source of low-emission power.
And while Europe is reassessing the strategic value of nuclear energy, China looks set to overtake France and the US as the world's biggest producer of atomic power by the end of the decade. Beijing is maintaining the pressure on its nuclear power giants to deliver more reactors with an ambitious new target. The government last week set a goal of 110 gigawatts of nuclear capacity by 2030 in its latest 5-year plan, a 76% jump from the end of last year. Well, our next guest runs GE Vernova an energy equipment manufacturing and services company. It's also, the company has a substantial and long-standing presence in the Middle East, especially in Saudi Arabia, Iraq, and the UAE. Joining us exclusively, CEO Scott Strazik. Scott, good to have you with us.
Haslinda, thanks for having me. I appreciate it.
We talk about nuclear energy. I mean, you're a developer, major developer of advanced nuclear energy. What's your take on the impact the Iran crisis is having on how companies and governments are thinking about nuclear energy?
Well, I think if I take a step back a few years ago in COP22 in Dubai, I sat in a room with 22 heads of state that said that by 2050 we needed to triple nuclear power generation in the world by 2050. So I think over the last 2 to 3 years it's been very clear that we need to substantially grow our nuclear power industry in the Western world, because post-Fukushima there's been no new build in the last 14 years. We're starting to see that change, though. We're building our first 300 megawatt small modular reactor in Canada right now. It'll be commissioned and generating new electrons by the end of the decade. And we see real activity in the US and Poland and Sweden. I think we're going to start to see a lot of nuclear build in the Western world in the years that follow.
How about the Asian world? I mean, the likes of Japan might want to consider that again.
No question.
And we had Van der Leyen expressing regret almost. I mean, what are you seeing in terms of real demand?
Yeah, we have a great partner in Japan, Hitachi, that we work with in a joint venture, and we've started to see Japan restart our nuclear reactors in Japan. We're also working with the Japanese government and the US government on a trade deal that would drive up to $100 billion of new nuclear development in the US that's in partnership with the Japanese government and with Hitachi. So this is starting to move in our direction.
How about in terms of other Asian nations, especially in emerging markets where they're so dependent on energy right now?
No question. I think even where we're sitting today in Singapore, this is a very logical place for small modular reactors because power density is so important. We need to create a lot of electricity without a lot of land. So this will come over time. Now, it's likely going to start in some of the larger economies in the world, like the US. Japan will definitely play a role, but Singapore is frankly another very good example that over time I see a very appropriate fit for SMRs.
You know, the conversation around the Iran war has been about energy.
Yes.
I'm just wondering on the back of that, in terms of demand across the energy space, including, you know, gas, renewables, what are you seeing? How are countries positioning on the back of that?
I think it's becoming even clear that energy security is national security. And with that, there's not one size fits all. It's not going to be about one technology. You're going to need an orchestra of technologies and applying the right technologies where the right resources exist. Gas power is going to play a critical role in many parts of the world. Nuclear will expand. But where there's good wind and solar, we're going to have to use those natural resources too. And while we're doing all that, I think what's becoming more and more apparent is all countries in the world need to reinvest in their grid, because as you add these different technologies into the system, you need a smarter machine, a smarter grid to orchestrate it together. And that's one of the biggest things we're working on in GE Vernova right now.
So which countries are investing in a bigger way in their grids?
Well, I think the U.S. is certainly having to modernize their grid right now. Europe is doing much of the same. The more that you have electrons moving in multiple directions, think solar panels on roofs with people selling electricity back into the grid, the more complicated it is. And that requires not just the physical hardening of the grid, it also requires more grid software. So we have a growing grid software business with grid orchestration, Grid OS we call it, that's really helping our utilities throughout the world manage the complexity of more variable power with things like wind and solar, but also electrons that are working in multi-directional ways.
Of course, energy, a big thing for the AI developments as well. You know, data centers, that's adding to the stress of having to produce more energy.
It does, but it also creates a customer base that cares deeply about sustainability. And then because of that, it's helping us move technologies to the left. So if you go back to SMR, our small modular reactor technology will definitely be developed at scale faster because the hyperscalers are willing to pay for that decarbonized power. If you think about carbon capture, applying carbon capture to gas plants, that's moving to the left because of the AI demand. So it's driving a lot more need for energy, but it's also in the end going to drive much more decarbonized power over time.
Gas turbines, where are you with that in this conversation of energy security? And, what are you seeing in terms of demand and how much usage is there at this point in time?
Well, we're certainly seeing both the utilization of our existing fleet go up because first and foremost, economies in the world need to maximize what they already have. And in the case of...
Go up, can you quantify that?
Well, it's just with the existing install base, they're running more. They're being turned off less. Customers are investing in more upgrades to their existing fleet so that they can get more megawatts with what they already have because it's faster to do that. Now, at the same time, we're working really hard to ramp up the production of our gas turbine capacity to meet this moment globally because demand for gas turbines is up substantially. I mean, globally, we lived in a world last year with almost 90 gigawatts of new orders in the world in which GE Vernova is working to have a very healthy share of that market.
So in terms of turbine slots for 2029, I think, is that done or?
No, we're still working. We still have real opportunities to meet this moment in 29 with customers because what's really happening is the gas turbines are part of the equation, but it's also construction companies that need to build it. It's also getting the LNG where it's needed, the natural gas. So what's happening with a number of our orders is we're already seeing demand in 30, 31, really into the next decade, but we do still have slots available for 2029. We'll sell them, certainly, but it's not just about the gas turbine. There's a lot of other variables at play, too.
But what are those variables, and are you expecting an acceleration on the back of it?
Well, we're certainly creating an acceleration with our gas turbine production. So we've talked about stepping up our gas turbine manufacturing capability in the third quarter of this year, 2026. We will grow our gas turbine production in 27. We will grow it again in 2028. So we see a clear pathway over the next 3 years to substantially increase our gas turbine output while the system around us builds the plants and gets the gas to where it's needed.
I'm just looking at the number of that refers to your backlog, $123 billion.
Yes.
Any change in that?
Well, it's growing with every day.
Scott, you can do better than that. Give us some numbers. I mean, has your backlog increased beyond 123?
Yes, we've talked about by 2028 we see at least a $200 billion backlog, and it's not a straight line, but I would say we continue to see very strong demand in the first quarter of this year that'll continue to grow and expand our backlog, and to do that in a very profitable way. And $200 billion may in the end be conservative based on the solutions that we have available to meet this moment, and that's really what we're focused on doing every day, is investing to meet this moment.
You're optimistic about the potential and the growth outlook. Is there a need for acquisitions? What would lead to that?
Yeah, we closed on our first material acquisition in the first quarter this year in February, a $5.3 billion acquisition of a partner that we had in the grid space for transformers. We're very excited about that first acquisition, but we also still sit here today in a net cash position as a company with an ability to certainly play offense and add to the portfolio. So as we can find businesses that are really right in our core, that give our teams a better opportunity to meet this moment and fulfill in what really is the beginning of an investment super cycle into electric power, we'll look to do those transactions.
But which businesses in particular are poised for that? I mean, you talk about how your pockets are pretty deep. You are able to mobilize your cash.
Yeah, I think the most likely places in electrification, the grid at large, because regardless of which technologies you talk about, whether it be nuclear, whether it be gas, whether it be wind and solar, all of those technologies are going to need incremental investments into the grid, both to expand and modernize it. Now, our power business is our largest business, and we're motivated to help electrification become similar in size over time. So our larger M&A focus right now is in the electrification space.
Before we pick up on electrification, I know that you have been in conversations with the White House, with the Trump administration. What are those talks about? What are they wanting from from your company?
Well, when I think about when President Trump and his cabinet came into office, they immediately talked about an energy emergency in the country. So by default, that creates very high expectations on a company like GE Vernova, because in the U.S., over half of the electrons every day in the country are produced with our equipment through our customers, utilities, independent power producers. So they have a very high expectation that we're able to ramp up to meet this moment. And equipment supply, we're working really hard to do that. But we also need to make equipment tomorrow in probably a different way than we made it yesterday, because we also need to meet the affordability moment in the U.S. And the administration has high expectations of us being able to do both. Grow our supply to meet the moment, but also to meet the affordability expectations. And we're investing to do that, but that's really exactly what a company like Vernova wants, is really high expectations from our government and our customers, and we certainly have it in this case.
How much growth in supply, and by when? For the U.S.?
Yeah, I mean, you think in the U.S., if I talk about our overall supply in gas as an example, last year we were making about 16 gigawatts of what we call simple cycle gas turbines. We've talked about that being 24 gigawatts by 2028. So, I mean, that's substantial. You're growing our supply by almost 50% in that period of time. And we're not necessarily stopping there. We think as we make investments into our factories, we'll find opportunities for productivity. So last year in our factories in the U.S., we added over 200 new machines. That is going to drive more output and productivity. We're going to add another 200 machines this year, and we're not necessarily done there. So we're going to keep working really hard to meet this moment.
Can you keep costs low to ensure that consumers pay a lower price for it?
Yeah, I think at the end of the day, for running a company as I am, I think volume gives us an opportunity to transform how we work. So in the near term, costs are more expensive because we're having to buy a lot more machines. We're having to pay premiums to our suppliers to get the inputs to our gas turbines. But on a larger market for a longer period of time, we're going to have to drive authentic productivity. And as we drive that productivity, costs are going to have to come down. There's no question about that.
But right now, are import costs higher? I mean, considering the disruptions we're seeing, not just in Iran, but elsewhere as well, supply chains getting impacted. I mean, ships getting rerouted.
Yeah, our costs are higher today. There's no question about it. Our price is also substantially higher, and we're expanding margins in that process. But we're not a company that sucks our thumb with costs going up. We need to take that on and work on fixing it. And that's what we're working to do. So we're investing in AI and automation in different ways that's going to allow us to make products tomorrow in a different way than yesterday. And that will drive productivity, and that will drive an ability for us to drive affordability into the system too.
Interesting you talk about AI.
Yeah.
AI is also, likely to lead to efficiencies. Might that impact your orders going forward?
Well, today it's certainly a catalyst to increased orders. I mean, last year, call it the AI demand cycle, really the hyperscalers, it was about 10% of our order book. We think it'll be a larger proportion of our order book in 2026, but we're just not focused on powering the data centers that create the AI. We're also using AI in our systems in different ways to drive engineering productivity, because we probably can't hire the engineers fast enough to meet this moment. So our volume is going to grow much faster than our engineering workforce, and that's really because of our leverage of AI today.
And speaking of hyperscalers, I'm just wondering whether you think the level of investments we're seeing right now, which is massive, is actually sustainable.
Certainly in the near term it is. I think you see the CapEx and the balance sheets of these companies, and they certainly have the ability to invest. I think you see the transformative nature of this technology every day, and we see it inside GE Vernova every day. And we're seeing the returns with our core operations ourselves. So by default, I understand why they're investing into it, because we're seeing the returns on our end with our own operations. On my end, we think this is the very early stages of really transforming how we work. And that CapEx spend that's happening this year is going to be sustainable for a period of time.
And the question is what that period of time is. I mean, there is already a debate on whether there is a bubble or not, and some say definitely there is. It's just a matter of time. How are you hedging that risk?
Well, when people reference bubbles, they're often talking about equity valuations and things like that, and that's less my game to play. What I would just say is there's a clear need for more electrical power infrastructure. There are going to be winners and losers in this AI system for certain, but the winners are going to need the electrons to run their business. So we have a pretty high degree of confidence that not just over the medium term, over the long term, we've got an ability to keep growing this business, serving a market that needs more electrons, because beyond the data centers, if you just take a step back, the world needs more energy. And today it only gets about 20% of its energy from electric power. The other 80% is still coming from the molecule. And that shift from the molecule to the electron, most people believe needs to lead to electricity as a proportion of energy to double over the next 20 years. That creates an incredible opportunity for us. So yes, the hyperscalers are an important customer, but it's a much larger demand cycle than just AI that has us investing in our businesses to meet this moment.
I'm curious, you talked about how there'll be winners and losers.
Yeah.
Will the winners be the hyperscalers? From where you're seated, are you confident they will all survive?
Oh, that's not for me to opine on. I can tell you that we work with all of them today, and I find a lot of inspiration in what they're doing. And I see a lot of transformation that's happening that's giving us tools ourselves to run our business better. I think by default, with the significance of what's happening and economies evolving with this technology, there are going to be larger winners than others. But I'm not one to be smart enough to call that right now, other than to say that this is very early, and we're quite motivated to serve all of them.
And what are you seeing in terms of energy demand for the likes of India and China as they ramp up their AI ambitions?
Yeah, I think Asia broadly is just seeing an incredible amount of demand growth. I mean, India is ramping up considerably. That's a big country for us. We have over 10,000 employees in India to help serve that market for India and for the world. You look at ASEAN at large in Southeast Asia, and it's the fourth largest energy economy now, electric power economy, where there's a lot of growth. I was in Vietnam earlier this week, and we just commissioned the first 1.6 gigawatt LNG to power plant in Vietnam, and 1.6 gigawatts is a lot considering they only have 90 gigawatts in their entire system today. And we signed contracts for 3 more 1.6 gigawatt LNG power plants in Vietnam. So we look at Asia broadly and view the strategic opportunities as significant and ones that we're continuing to invest in.
But in terms of energy needs for a country like India,
yeah.
I mean, what assumptions are you making, and what potential do you see there, and what kind of partnerships or tie-ups do you see in India?
Yeah, I mean, we see substantial growth in traditional renewables technologies like wind and solar. We have a large wind business in India. The fastest growing business for us in India is our grid business, because as you make those investments in solar and wind, you need to invest in the grid to connect the power generation sources to where they're needed. So exact trajectory of percentages, I'll leave that to others, but it's a growth market and a market that we're motivated to serve.
And Scott, I'm curious to get your views on the trends that you see developing in the energy space. What should we be looking out for? What's underappreciated right now?
I think there are many debates on different technologies in the FIT, but what's going to become more and more apparent every day is it's going to be applying the right technology where the resources exist, and many technologies are going to be needed. We'll likely spend less time talking about the power generation sources and more about the grid itself, because as we continue to invest in the grid, we'll drive efficiencies and affordability solutions that aren't otherwise apparent without those investments. And that shift towards the electrification of economies is going to require a substantial investment in the grid, as much as today we've talked about nuclear power or gas power or wind power. A lot of this is going to be the modernization of the grid itself. And
fuel shortages might be a thing of the past, do you think, at some point in time? I mean, when you take a look at what's happening in Iran, it's causing those fuel shortages in a lot of countries. How do you position positioned for that?
Yeah, there's always going to be geopolitical volatility in the world, and I think that's why you've got to depend on a lot of different forms of power generation to be able to buffer that, for sure. And I think smart economies are going to do exactly that. I think you are also going to want to have power generation sources that are as local as possible to minimize the global chessboard that's being played out right now and the volatility that exists with that.
Scott, great having you on the show. Thanks so much for stopping by.
Thanks again for having me.
Scott Strazik, CEO of GE Vernova. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and here are some stories we are following. Oracle shares jumped in extended trading after the company posted results that beat estimates and gave an outlook that suggested little let-up in demand for AI computing. Revenue in its infrastructure business gained 84% to $4.9 billion in the last quarter. The company is working to deliver cloud infrastructure contracts with customers such as OpenAI and Meta. Bill Ackman is returning to the IPO market with a combined offering for his hedge fund manager and Pershing Square USA, a new closed-end fund. Ackman is looking to raise between $5 and $10 billion in the combined deal. The offering marks a fresh attempt by Ackman after plans floundered in 2024 for an IPO raising as much as $25 billion. And NEO has posted its first ever quarterly profit, topping $115 million for the December quarter. That follows a loss in the same period last year of more than $873 million. NEO's high capital requirements and focus on the middle-class market have drawn investor skepticism amid an increasingly shaky demand outlook. And before we go, here's a look at our guests for tomorrow. Morgan Stanley's Jonathan Garner will join us with his take on which markets are the most resilient to energy shocks. Keep it here with us. This is Bloomberg.